U.S. stocks posted losses during the month of August with elevated volatility and below average trading volume. Losses were generally driven by the escalation of trade tensions and tariffs between the U.S. and China, and also global economic data that continued to come in worse than expected. Ultimately, the S&P 500 finished the month about 3% below recent all-time highs. However, over the past 12 months, the S&P 500 index has a price return of roughly zero, with plenty of volatility in between. Foreign stocks also posted losses during August and were negatively impacted by foreign currency weakness versus the US dollar. Most notably, China allowed the yuan to weaken below 7 yuan per US dollar, a mark that the yuan has not slid through for over a decade. After the US Federal Reserve cut short-term interest rates at the end of July, interest rates in the US continued to move lower during August. The U.S. 10-year Treasury note yield fell below 1.5%, rapidly approaching the all-time low of 1.36%. And the U.S. 30-year Treasury note yield fell below 2%, a new all-time low. This also fed through to drive 30-year fixed-rate mortgage rates down to 3.7% on average, approaching their all-time low. And if you think interest rates can't go much lower in the U.S., just take a look at what's going on overseas. There's now roughly $17 trillion worth of negative yielding debt outstanding. For example, the German government can issue new debt at any maturity at a negative interest rate. And this is also feeding through into the mortgage market in the euro area. In Denmark, you can get a 10-year fixed rate mortgage at an interest rate of negative 0.5%. So this rapid decline in interest rates globally that we experienced during August led to very strong returns for high-quality bonds during the month. We're seeing increasing evidence that the ongoing trade war between the U.S. and China and slowing economic growth overseas is having a negative impact on the cyclical areas of the U.S. economy. For example, looking at purchasing managers' indices, which in the U.S. recently dipped into contractionary territory, and then cyclical indices such as freight indexes and North American truck sales all confirm that the cyclical areas of the U.S. economy are slowing. The global economic slowdown hitting the U.S. is also being confirmed by yield curve inversions, or the difference between the yield in the 10-year Treasury note and the 2-year Treasury note. This spread went negative for the first time since 2007 and is commonly referred to as the smartest economist in the room, as an inversion between the 10s and 2s has occurred 12 to 18 months before each recession since World War II. Thankfully, we've seen minimal evidence that the slowdown in the cyclical areas of the economy has started to negatively impact the U.S. consumer, which represents roughly 70% of U.S. economic growth. On the positive side, we've seen weekly jobless claims and unemployment rates at all-time lows with strong consumer spending. But on the negative side, the Bureau of Labor Statistics recently published that they overestimated the number of jobs added during 2018 to the tune of 501,000 jobs, implying that maybe the U.S. consumer and the labor market aren't quite as robust as previously reported. This is also the largest downward revision in non-farm payrolls since 2008. With U.S. equities still near all-time highs, but with deteriorating momentum and signs that the U.S. economy is beginning to slow, we think defensive positioning is still warranted in client portfolios.